Mexico is on the verge of a once-in-a-lifetime opportunity, according to Bank of America, as the country prepares to compete with China in the manufacturing industry. According to the bank, global supply chain difficulties, the country's free trade contracts, and a breakdown in US-China relations have resulted in Mexico having the best growth opportunity for the next 10 years. So, is Mexico the new world's factory? And is China going to lose its place as being the #1 exporter of goods in the world's trade? Let's find out in today's video. China's exports fell 6.3% in April 2023 compared to March. Chinese imports were significantly worse in the same month, down 7.9% year-on-year. An amateur eye would attribute this drop in trade activity to a lingering effect of last year's zero-COVID policy. The real reasons, however, are far more complicated. After the long-running trade war that has strained US-China relations, in which both nations imposed high tariffs on goods, the UN estimates that Mexico will capture nearly $27 billion in lost commerce, the greatest amount by any one country. And it's more than just talk. Transformation is already on its way. The food, basic metals, mining, pharmaceutical, and automobile sectors are expected to invest the most in the country, with the latter being a critical strategic component of North America's aim to disconnect its supply chains from the East and establish themselves locally. Ford has committed $260 million in its new global technology and business hub in Mexico, while Volkswagen has reportedly invested $763 million in its electric vehicle manufacturing. While Central America is already an important hub for producing certain parts for automobiles, with traditional labor costs comparable with China, it will need to raise its image and expand its capabilities in more specialized production, such as technologically advanced parts and electric vehicle supply chains, to fully take advantage of the disintegration of the US-China connections. Yet, it has been like that before. Let's start with a look at how China has been a dominant character all over world trade up until now. So, first things first. There's no second opinion on the universally agreed upon fact that China has been the world's factory for a pretty long time. Made in China is one of the most well-known phrases on the face of the planet. It is frequently associated with a low-cost product, which is frequently outsourced by large Western firms. For decades, China has used its low labor costs to attract wealthy firms to their country. This was a wonderful strategy. Because of its labor force, China has become the world's second largest economy. Its massive economic expansion in such a short time span is unique in world history. Considering the COVID-19 outbreak and political instability, China has shown to be an appealing and trustworthy investment location. China's GDP grew by 8.1% to RMB 114.4 trillion, which is US $17.7 trillion in 2021, which was even more than the entire European Union, which stood at 15.73 trillion. And the second biggest economy in the world does not appear to be slowing down anytime soon. China has also acquired other advantages to support its global market leadership and retain investor trust. These include its massive market development potential, skilled labor pool, outstanding infrastructure, and ever-improving capabilities as a manufacturing base for future industries. Within the first 20 years of the 21st century, the West regarded China with adoration, which quickly turned to fright. Before the start of financial reform and trade liberalization about 40 years ago, China's policies kept the economy underdeveloped, stagnant, centrally regulated, enormously ineffective, and somewhat removed from the global economy. Yet China has been one of the world's fastest-growing economies since establishing foreign trade and investment and implementing free market reforms in 1979. With real annual GDP growth averaging 9.5% through 2018, a rate described by the World Bank as the most rapid sustained growth by a major economy in history. Such growth has allowed China to quadruple its GDP every 8 years on average, lifting roughly 800 million individuals out of destitution and misery. China has surpassed the United States as the world's largest economy in terms of purchasing power parity, and as a supplier, retail trader, and holder of reserve currencies. As a result, China has become a key trade partner of the United States. China is the United States' largest merchandise trading partner, largest supplier of imports, and third largest export market. China is also the largest overseas holder of American Treasury assets, which help pay the federal government's debt and keep interest rates low in the United States. So, if China was doing that good in everything, then why Mexico now? Well, the #1 reason is the diplomatic relations and trade agreements with the United States. Mexico enjoys substantially better bilateral relations with the United States than China. Although not without problems, the relationship has improved dramatically since the United States President Joe Biden took office in January 2021, prompting the reintroduction of various mechanisms of conversion and collaboration that had been discontinued under the previous government, such as the North American Leaders Summit. But even after the administration of former Vice President Biden took over the White House, China-US relationships remained fragile. Despite popular belief, Biden did not reverse Trump administration tariffs on Chinese imports. Furthermore, escalating tensions as a result of the Russia-Ukraine war increase concerns that China may be sanctioned inadvertently as it continues to cooperate with Russia. Some international corporations in China have indicated that political tensions between China and the United States, particularly in the aftermath of the Russia-Ukraine crisis, have become a growing reason for enterprises to abandon the Chinese market, as they risk being caught in the crosshairs. According to a recent European Chamber of Commerce flash survey, 7% of companies have already considered canceling current or planned investments due to the risks connected with the EU-China geopolitical tensions. As a result, some corporations may regard Mexico as a lower-risk choice for their business. The second reason for the country's shift from China to Mexico is the growing economy of Mexico itself. Mexico has the second largest economy in Latin America, according to the World Bank. Its GDP reached $1.29 trillion in 2021, representing a 4.8% increase. Mexico has a big and distinct economy, and at the moment it is the United States' second biggest trading companion, estimated for 14.5% of total trade in the first quarter of 2022. Electronics, autos, gasoline, minerals, polymers, and machinery are among the top U.S. exports. Furthermore, Mexico is the U.S.'s second largest agricultural export market, importing $19.5 billion in U.S. crop goods in 2018. An advantage of making investments in Mexico is that the companies and vendors over there are familiar with U.S. goods and services. Typically, U.S. companies find it simple to sell their goods in Mexico. Farming, auto parts and offerings, the aerospace industry, education services, energy environment technology, information technology, transportation infrastructure, and tourism are among the promising industries for U.S. enterprises in Mexico. Also, the United States has levied tariffs on approximately $300 billion in Chinese imports. These items have been divided into 4 lists, with the first 3 approved in 2018 and the last list approved in 2019. Tariff rates on some imported commodities might reach 25%. According to PIIE, average U.S. tariffs on Chinese exports remain at 19.3%, more than 6 times higher than before the trade war. These taxes apply to 66.4% of Chinese imports into the United States. In contrast, the United States-Mexico-Canada agreement stipulates that there be essentially no import taxes on Mexican goods entering the U.S. Goods that are still subject to import tariffs can benefit from a decreased rate, making them cheaper to import from Mexico than from many other nations. Another potential incentive for corporations to reshore to Mexico is the cheaper cost of doing business there. Rising wages have stemmed from China's achievement in building its economy over the last few decades. China's average minimum wages, which vary by area, are currently greater than those in Mexico. Another factor to consider is the cost and duration of shipping. Because of its proximity to the United States, shipping goods from Mexico is less expensive and faster than from China. This is especially true in the post-COVID period, as the pandemic's influence is still felt in the form of exorbitant transportation prices. So, of course, the perks of China are difficult to match, but people are gradually realizing the distinct advantage of manufacturing in Mexico as well. With new manufacturers opening in Mexico every day, the next 2 decades should see Mexico enter a historical period of wealth and expansion. But what are your thoughts on this shift? Let us know down below. If you found this video interesting and informative, then hit the like button, share it with your friends, and subscribe to our channel. And while you subscribe, don't forget to turn the notification bell on to stay updated with the latest economic news and updates. Thanks for watching.